In the previous video, I gave you the 4 key levels that no one talks about. On their own, they already give you an edge. But if you learn to combine this with cycles, it will completely change the way you see the market. And I'll be honest with you, if someone had shown me this video 2 years ago, it would have saved me 2 years of jumping from one concept to another and looking for a thing that finally works. Because this is the thing, when you put the key levels together with time, you stop guessing and you start thinking like a big players. So in this video, I will break down cycles, every type of cycle, and exactly how I use them in my own trading. Because time is the one factor that most traders completely ignore, and it's the very important thing that gives you the edge. Let's break it down. So first of all, let's start with the basic term. Quarters are built on one idea. The market moves in blocks of time, and every block splits into 4 quarters. Each quarter has its own job, and they run in order. Let's break down each quarter and their roles in the market. First quarter is accumulation. Price ranges and builds a base. This is where large capital quickly builds in position and liquidity forms around the range. First quarter is usually the quiet quarter. Price moves slowly and stays in a small range. There is a low volatility. Second quarter manipulation. Price breaks out of the first quarter range, usually in the false direction first. From my own trading, I noticed something useful about second quarter. In this quarter, price acts like a magnet. It gets pulled toward liquidity. And clearest liquidity is the high and low of the previous cycle, because second quarter is manipulation phase. The market usually runs to one of those two levels first, the previous cycle high or the previous cycle low. So before the real move starts, price often goes and takes one of these sides. This gives you a simple bias. You look at the previous cycle, you mark its high and its low, and you watch which side price goes to take in the second quarter. Third quarter distribution. The real impulsive move in the true direction. This is what all the manipulation in the second quarter was setting up. The main leg of price happens here. And the last fourth quarter. It's basically continuation or reversal. Price either extends the third quarter move or turns and starts preparing the next cycle. So the sequence is simple. First quarter builds the liquidity, second traps, third delivers, and fourth is closes the cycle. I'll be honest, this is the basic knowledge about quarters, not a rule. The market doesn't have to give you this clear behavior every day. It's a map to help you know what to expect. In real trading, the manipulation is often missing or messy, and some days, at trend days, price goes one way all cycles, with no trap. Third quarter is also not always the big move. Sometimes you can see that it's weak, sometimes the real move comes in fourth quarter. So the real skill is not finding the setup every day. It's seeing the difference between a clean cycle and a dirty one. Honestly, about 30 or 45% of cycles are clean. Your job is to find those days and to do nothing on the other days when the charts are messy. You might be thinking, if the 40% of cycle are clean, why trade them at all? First of all, you don't need every cycle. The 40% is not a weakness, it's just a filter that helps you to see a good setup. Most traders lose money because they try to trade everything, including the messy 60%. If you only take the clean cycles and skip the rest, your results get much better, even with fewer trades. But this only works if you can wait. And this brings me to the most important thing. Let's be honest, your only real edge in trading is your patience, nothing else. You can have good expensive indicators, you can have a good order flow tools that allows you to see real volume, but if you have no patience, none of them will help you, really. You will still jump into the messy 60%, force bet trades and lose. So patience is the whole game. For me, trading is the game where you learn patience and discipline first. The trader who waits for the good setup and does nothing when the charts are messy will be the trader with expensive tools and no discipline, really. Okay, so we covered the basic idea, the 4 quarters and what to expect from each one. But one thing, don't expect the market to do exact same thing every time. It's always a little different. The quarters give you an idea of what to look for, not a fixed rule. The indicator has 4 cycle types, from the biggest to the smallest. Each one splits into 4 quarters. The biggest one is the weekly cycle. It splits the month into 4 weeks. You watch it on the 1 hour time frame and higher. Next is the daily cycle. It splits the week into 4 days, from Monday to Thursday. Each quarter starts at 6 p.m. New York time. You watch it on the 50-minute time frame to the 1 hour time frame. Then the 6 hour cycle. It's also called like a session cycles. It splits 1 day into 4 sessions. Asia, London, New York AM and New York PM. You watch it on the lower time frame, 5 minutes and below. And the last one is 90-minute cycle. We start watch the first 90-minute cycle at 7 p.m. And during whole day we have 12 90-minute cycles. It splits each session into 4 small quarters. The indicator does it for you. In auto mode it shows the right cycle for your time frame. So for example, if you open a 3-minute time frame, the indicator will show 90-minute cycles and 6 hour cycles. If you switch to 50-minute time frame, it will display daily cycle and so on. So now let's talk about quadrants. Every cycle has quadrants inside it. What I do is take a cycle and stretch a Fibonacci on it, and I look of real levels, 25%, 15% and 75%. These levels help me see a zone where price can react, where it might turn or show the start of reversal. Let me show you how I personally use them. I trade intraday inside the session. So most of the time, I use daily cycles like high time frame buys. The first thing I noticed, when the market is trending, price often comes back to 25% or 15%, bunch of it, and continues in the same direction. So in a trend, these levels work like a support. Price taps them and goes further. The second thing is about reversal. For me, the 15% level of the previous cycle works like a wall. When the market is really strong, it closes through it with an impulsive close. When the market is weaker, that level holds the price back and it can break through. This is like a piece of context, not a green light to jump into a position. The second thing I always do is mark a previous high and previous low of the high time frame cycle. In my situation, it's a previous cycle daily high and low. For me, this is liquidity, the levels the market wants to take. Let me walk you through example where I took a good profit. First, the context. The first thing I did was mark the high and low of previous daily cycle. As you can see, my indicator shows it right here at the top. Then the London session have started. I mostly watch for entry in macros. And the first macro window 245 to 315. And as you can see, it didn't give me a good entry points. And let's look at second macro window. The price rejected the truly open FVG level. About truly open levels and so on, I have explained about this in my previous video, so you can watch it on my YouTube channel. After price touched the truly open, there was a very good reaction. I opened a long position. My logic was if the sellers were really stronger, they would push price down and break through this level. But the buyers held it. So I understood if buyers are holding here, then there is a liquidity above. And price will probably go up to take this liquidity. And how I used the 90-minute cycle here. As price came back to our really open level, you can see liquidity from the previous cycle had been swept. And at the same time, we had a very good confirmation, sequential SMT divergence. One cycle made a new low, the other didn't. So right at this level, we had two things together, the manipulation and the divergence. That gave me a very confident entry, and I already knew where liquidity was above. As you can see, price went up and swept the previous day cycle liquidity. Next, during the New York session, the market swept the liquidity. And you can see a really good rejection there. As we know, the third quarter is usually the distribution. So I waited for the third 90-minute cycle to get a good entry. And as you can see, as soon as the third 90-minute cycle started, we got a good point to open the position. We also had a divergence at the same time. If we look at Dow Jones, we can see price didn't swept the high, but on the Nasdaq, it did. And these were good confirmation factors before a reversal. And pay attention to the 90-minute cycles here. You can see that the manipulation happened exactly in the second cycle. As you remember, I mentioned about second cycle is manipulation. And the third cycle is distribution, good cycle for reversals and volatility moves. And as you can see, the second cycle has swept the liquidity, and the third cycle delivered the price to key level. Okay, before we go to divergence, let me explain about each cycle and what to look for. If you're a swing trader and you hold position for days, basically you need to pay attention at weekly cycles. You watch it on the 1 hour time frame and higher. If you're an intraday trader like me, you can use the daily cycles and 6 hour cycles like high time frame cycles. You need to use it like a bias. And for entry, you use 90-minute cycles. The daily cycles give you the direction for the day and liquidity. And personally, I watch at 6 hour cycles high and low as a liquidity target. Or also you can catch a manipulation. And when I want a precise entry inside a session, I dropped the 90-minute cycle on the lower time frame, the 5-minute time frame or below. So the idea is simple. The bigger cycle is your high time frame context and direction, and smaller cycle is your timing for entry. So now let's talk about divergence, sequential SMT divergence. This is one of the main things I use to confirm my entries. Let me explain it simple. You compare two related markets, for example Nasdaq and S&P. They usually move together. But here we don't look at every swings. We compare external swing points of the cycles, one cycle to the previous cycle. For example, the second cycle makes a new high above the previous cycle's high, but the correlated asset doesn't make the new high. That is a sequential SMT divergence. One market took the level, the other didn't. For me, this is a strong sign of weakness. So when price sweeps the liquidity and at the same time I see the divergence between the cycles, it tells me the SIP is the manipulation. So in simple terms, the cycles help you to identify timing. The liquidity gives you the potential target. And the sequential SMT divergence confirms the move is weak or not. Now let's quickly go over the indicator settings for those who already get Dropins Pro, or if you want to get this indicator you can check description and visit my website. First, for quarterly cycles there is an automatic mode, which will display cycles based on your current time frame. For instance, on anything below to the 50-minute time frame, you can see the 90-minute cycle and 6-hour cycles, which are very helpful for finding your entry points and spot manipulations. From 50-minute time frame to 1 hour time frame, the indicator displays daily cycles, and from 1 hour time frame to higher, it displays weekly cycles. Also, there is a manual mode. If you turn off the auto feature, you can choose exactly which cycle you want to see on your chart. For example, if you want daily cycles to be displayed even on 3-minute time frame, you can easily do it in the settings. Moving on, you can fully customize the style of each cycle to fit your preferences. You will also notice that there is a flip button for every cycle. This function plots a Fibonacci grid that shows quadrants, helping you spot potential reversal zones within the cycle. Personally, I only use them on 6-hour cycles and daily cycles. because these specific levels provide me much more context from the higher time frame. Further down in the settings, you can choose whether to display the previous high and low of the cycle. As I mentioned before, these are crucial liquidity pools that the price will target. You can either configure this manually from a specific time frame or keep it on automatic mode, which will dynamically display them based on the current cycles on your chart. So let's do a quick recap. Step 1. Read the previous cycle. Before anything, I always look at what the previous cycle did, because it sets the context of the current one. I mark the previous daily and 6-hour cycles high and low. That's my liquidity and my bias. Step 2. Wait for the right quarter. I know that second quarter is manipulation, and third quarter is the real move. So I'm not entering randomly. I wait for the cycle to reach the moment where the move usually happens. Step 3. Confirmation. I look for sequential SMT divergence between the cycles. If one asset slips its swing point and its correlated one doesn't, they tell me that the move is weak. When all of these come together, the context from the previous cycle, the right quarter, and the divergence, that's my entry. So let me show you a couple of examples that you will understand it much better. Let's break down the first example. First, look at the daily cycle. As you can see, price swept the liquidity, the previous high, and at the same time it formed a divergence. So already on the daily we have the two things we want, the liquidity sweep and the SMT. Now let's go down to the lower time frame. The green boxes are the 90-minute cycle during New York session. Look at how it's play out, cycle by cycle. The first cycle formed a small consolidation. The second cycle is fully manipulation, and it formed the divergence. And the third cycle, the real move. For the entry, I mainly watch the macro window. Let's watch at first macro window, 10:45 to 11:15 window. You can see that through the open level and the 6 p.m. level get tested inside it. And after that, the market is already fully reversed and goes down. So the structure here is simple. The daily cycle gave me the context with the sweep and the divergence. For entry, we use 90-minute cycle, and the second cycle did a manipulation. The third cycle delivered the move, and the macro window give you the precise entry. Let's look at another example. This is 50-minute time frame gold chart. And right here we can see that during the New York session, price swept the previous cycle liquidity, and at the same time was formed sequential SMT divergence. Silver didn't update the high, but gold updated. It already signals that our bias is bearish, meaning we should look for short position down to a specific level. Potentially, you could have opened a position right after the market structure shift occurred. Notice that this market structure shift formed during a macro, and your take profit could have been set right at through the open level. And let's break down our last example, Euro USD 15-minute time frame. Here we can see that the price reached a key to open 6 p.m. level, where it successfully formed a divergence. Specifically, Euro USD didn't update the swing high, but GBP USD did it, creating a sequential SMT divergence between cycles. Let's look at a lower time frame. A clear 6-hour divergence is visible here as well. Generally speaking, you could look to open position right after the middle of the second cycle after market structure shift. According to my experience, I noticed if the second cycle is already coming to an end, it's usually better to wait for the start of the third cycle and see the setup at first 15 minutes after start of third quarter. In the particular setup, an entry in the middle of the second cycle was completely valid, but personally I prefer wait for the macro. Looking at the first macro here, it didn't really offer a clean entry setup. But if we check the next one, we can see a clear 90-minute SMT formed, and that is exactly where you could open a short position after market structure shift or inverted fair volume gap. Potential target here could be the through the open level. I know this might look really hard and complicated, but honestly, trading just takes practice. You just need to give yourself some time. Month by month, it will get easier and make more sense. And once you finally get this logic, you will start seeing the market in a whole new way, a way that nobody talks about, really. I researched some videos about this concept and really no one talks about. I remember when I started, the amount of information was scary. And the man who teach me this concept, I trust him and just I give myself some time to understand how it works. And of course, the first time I did a lot of mistakes, and now I also do it because I also practice this concept and I'm learning this. But over time, those losses turned into my experience. And month by month, I understand better and better this concept. And I started to see my first results. And I simply let my mistakes teach me, and let it teach you too. So guys, thank you for watching. Trust the time, trust your mistakes, and learn from it. So guys, to talk in English a little hard for me, and what I want to say, thank you for watching. Trust the time, trust your mistakes, and learn from it. Turn off the panic and get a grip. And I will see you in the next video.